Our last chapter. We're finishing our look at topics usually considered top management issues, dividend policy and capital structure. Regardless of whether we're personally involved in the decisions regarding either, we need to understand what the options are and what the choices mean for the firm. In this part of Chapter 15, we'll get an overview of capital structure terms, theory, and evidence. Here's where this topic fits in our overall chart. We already know that the mix of debt and equity has a direct impact on the cost of capital of the firm. Basic definitions we'll be using in this chapter. We've seen all these in previous chapters. V is the value of the firm. FCF, free cash flow. WACC, weighted average cost of capital. RS and RD are the costs of stock and debt. WS and WD are percentages of the firm that are financed with stock and debt. This is our basic formula for the value of the firm, and the discount rate, the cost of capital used to calculate that value. Clearly, the value of the firm is impacted by the cost of capital, which depends on the mix of debt and equity the firm uses. Free cash flow is affected as well. The big change in the 2017 Tax Act is the significant reduction in the corporate tax rate from a top rate of 35% to 21%, a flat rate. The 2017 Tax Act also put limits on interest expense deductions, as shown on the slide. For 2018 to 2021, interest divided by EBITDA has got to be less than 30%. After that, interest divided by EBIT is less than 30%, but any excess can be carried forward indefinitely. Taken together, these changes should cause firms to reduce their use of debt. Business risk, uncertainty about EBIT, ROIC, and NOPAT, is driven by uncertainty concerning points directly related to the type of business. Demand, output prices, input cost, product liability, degree of operating leverage. The last item on the list, the degree of operating leverage, is addressed on the next slide. Operating leverage is driven by the proportion of fixed cost versus variable cost. Higher fixed cost, higher operating leverage. These graphs demonstrate the effect of operating leverage on EBIT. With higher operating leverage, a small change in sales results in a large decline in EBIT. We usually think of high operating leverage or high fixed cost in relation to break-even quantity. Here are the variables we'll use to find our operating break-even point. Q, quantity sold. F, total fixed cost. V, variable cost per unit. TC, total cost. P, price per unit. And the operating break-even quantity, Q sub BE. Note that fixed cost is a total dollar amount, while variable cost is per unit. Think of the denominator in this formula as the per unit contribution to fixed expense. In our example, with total fixed cost of $200, a selling price of $15, and a variable cost per unit of $10, the break-even quantity is $40. We've looked at business risk, which is directly related to the type of business the firm is in, and how that influences the risk of the company. Financial risk adds on to the business risk due to the use of debt and preferred in the firm's capital structure. Let's consider two hypothetical firms. Firm U is unlevered. It uses no debt. Firm L is levered. It has $4,000 of 8% debt in its capital structure. The total value of both firms is $20,000, made up of either all equity or equity and debt. But the similarity ends when we look at the income statement for U and L. U reports net income of $1,800, while L reports income of only $1,560. Both firms have the same tax rate, EBIT, NOPAT, and ROIC. Going further, U reports an ROE of 9%, while L is 9.8%. From this example, return on invested capital was unaffected by debt, but ROE went up, increasing the return to shareholders. Recall that we saw how debt could boost ROE. For firm L, more cash goes to investors, and L pays less taxes due to the deductibility of interest payments. But what happens if EBIT falls from $2,400 to $1,600? Both firms' ROIC and ROE fall identically. Further, what happens if EBIT falls from $2,400 to $1,200? Firm U's ROIC and ROE fall, but L's ROE falls more. Bottom line, leverage only adds value if return on invested capital is greater than the cost of debt. Firm L's cost of debt is 8%. At $2,400 EBIT, that added value with an ROIC of 9%. At 1,600 and 1,200 EBIT, it didn't. Capital structure theory is a fundamental concept in finance, originating with Mariani and Miller in 1958. M&M theories are by far the most well-known and cover three situations: no taxes, corporate and personal taxes, and there are a variety of other theories that we'll cover as well. Mariani and Miller 1958 was one of, if not the first work that related capital structure to firm value. With the assumption of no taxes, they showed that the total cash flow for firms U and L are equal, therefore the value of the firms must be equal. Note how the cash flows end up identical. U pays out all its net income to shareholders, as does L. Though L's net income is lower, it is already paid on its debt, the total of which with dividends equal firms U's total distribution. M&M 58 assumptions are shown above. The most critical ones are number 2 and 3. No taxes, no bankruptcy cost. These are relaxed in subsequent research, but for now we'll go forward with these assumptions in place. M&M 58 show that, as we've seen on a previous slide, if the total cash flows to the investors in two firms are the same, then the value of the two must be equal. If their values are equal, then so are their costs of capital. Conclusion: capital structure is irrelevant. In 1963, M&M relaxed the assumption of no taxes to include corporate taxes. Since U.S. tax law subsidizes corporate debt by allowing the deduction of interest payments, debt shields some of a firm's cash flows. From that, M&M 63 conclude that the cash flows of a levered firm are equal to the cash flows of an unlevered firm plus the value of the debt shield. Note that the debt shield is the required return on debt times the amount of debt times the corporate tax rate. M&M 63 conclusion is shown on the title line. The value of a levered firm is equal to the value of an unlevered firm plus the tax shield. The conversion from R sub D dt to TD involves considering the tax shield as a perpetuity and discounting it at the rate of the required return on debt. With a 25% tax rate, every dollar of debt adds 25 cents to the value of the firm. Not bad. The theory we've just covered is shown graphically on this slide. The implication is fairly clear. More debt is better. 100% debt is best. But recall, M&M still assumed no cost to bankruptcy. As we've noted before, the Tax Act of 2017 significantly cut the tax rate from the top rate of 35% down to a flat rate of 21%. While we've generally been using a tax rate of 40% made up of 35% federal, 5% state, we'll be using a 25% rate going forward. 21% federal, 4% state. This obviously reduces the value of the tax shield, dampens the slope of the line on the graph on the previous slide, and also increases the cost of capital. Miller, in a 1977 keynote conference address, extended M&M 63 to consider personal taxes as well. Corporate taxes favor debt, but personal taxes favor equity. Here's the formula for the value of a levered firm considering both corporate and personal taxes. Including personal taxes reduces the advantage of corporate debt. As we can see in this example, now debt only adds 6 cents to the value of the firm for every dollar of debt. Miller concluded that debt is still advantageous, but not as much so with personal taxes included. He still advocated 100% debt for a firm. Note that at this time the research on bankruptcy costs had focused primarily on railroads, which do not operate under the same bankruptcy laws as corporations. Based on the results of that research, Miller and Mariani continued to assume away bankruptcy costs since they were found to be very small for railroads. Subsequent research has proved this untrue for corporations. The 2017 Tax Act did not significantly affect personal rates on stock, though the top rate has declined from 39.6 to 35. Personal rates will revert to pre-Tax Act rates after 2025, and the effect is relatively minor on the Miller model. Continuing our look at Miller's formula, including personal taxes, the numerator is smaller since the corporate tax rate is lower. The Tax Act also affected the denominator by slightly changing the 1 minus the tax rate on debt term. Overall, the term in brackets is smaller, which reduces the value of debt. In answer to the assumption of no bankruptcy cost, the trade-off theory argues that up to a point the benefits of debt outweigh the threat of bankruptcy. Beyond this so-called optimal debt level, the potential risk of financial distress outweigh any benefit of more debt. This theoretical optimal debt level is shown in the graph on the next slide. The red line attempts to identify where the benefits of more debt begin to bring down the value of the firm rather than increase it. This is, of course, a theoretical construct, but firms do try to find a debt level they're comfortable with and then stay somewhat below it to provide room for emergencies or for good investment opportunities. Since the Tax Act of 2017 reduced the value of debt, it also lowered and flattened the curve. The act did not affect the cost of financial distress to a firm. M&M also assumed that investors all have the same information. But recall in previous chapters, we considered how insiders have better information than outsiders to a firm. Investors know this, so they read actions by a firm as signals. If a firm issues new equity, investors imply that the stock is overvalued, a negative signal. If the firm issues debt, the implication is that the stock is undervalued. Another theory is called pecking order. Intuitively, this makes sense. If a firm wants to finance an investment, the first source of funds it would tap would be retained earnings. They've already got the money, and they don't have to publicly disclose what they plan to do with it. The second choice would be debt. It's cheaper to issue than equity and doesn't dilute the value of the firm. The last option is new equity. If a mature firm issues new equity to raise funds, the implication is that they have run out of other sources. One theory regarding the use of debt suggests that debt imposes a discipline on managers, which reduces agency problems. If a firm has to meet its interest obligations, it reduces the funds available to be squandered. The most extreme example of this is a firm that goes through an LBO. The heavy debt load brought on by a leveraged buyout focuses everything on cash flow to meet the interest payments. A second agency issue is termed underinvestment. Since debt increases the risk of financial distress, managers may be reluctant to pursue what would be good but risky projects for fear of failure. The advice for managers is that firms should maintain some reserve borrowing power, stay to the left on the optimal debt curve. Managers might try to time the market in the sense of taking advantage of which way would be better to raise funds at any one time, debt or equity. Equity when stock prices are high, debt when interest rates are low. Empirical evidence testing each of these theories has found mixed results. Tax benefits are important. Bankruptcy is very costly, 20 to 30% of the firm's pre-bankruptcy value. Firms do have target capital structure weights, but do not make quick adjustments. Consider that market values shift minute to minute, changing the market value weights for a firm. In addition, firms don't issue debt and equity simultaneously, so it's hard to stay right on their target. Being above a firm's target debt percentage has a more negative effect on firm value than being below it. Companies will at times go above their target debt ratio if presented with an unexpected investment opportunity. Continuing the empirical evidence recap, we continue to see mixed results. After big stock price run-ups, debt ratios fall, but firms tend to issue equity instead of debt. That's inconsistent with the trade-off model, inconsistent with pecking order, but consistent with windows of opportunity. Many firms, especially those with growth options and asymmetric information problems, tend to maintain excess borrowing power. Clearly, there's still much to be learned about capital structure and how firms actually decide on their mix of debt and equity. From a management perspective, however, there are some general guidelines. If a firm has a high tax rate, stable earnings, and low operating leverage, then the firm can support a significant amount of debt. Firms with volatile sales, high operating leverage, numerous investment opportunities, and special purpose assets should be careful of their level of debt. They might need borrowing capacity to take advantage of an opportunity. And in addition, the special purpose assets do not make good collateral. With all of these implications for managers, the firm has to consider the impact a capital structure change will have on lenders and rating agencies. This ends Part A of Chapter 15. In Part B, we'll follow an example of a firm recapitalization.